This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
In our previous lecture, we dealt with the majority of the knowledge that we need to have to be able to deal with gift relief claims. Now, what we saw was that for a gift relief claim to be available, then the gift of the asset had to be a qualifying business asset. It's always the same with any of these reliefs pertaining to business assets. They have to be qualifying business assets, and so it was that we had to learn what those assets were. But what we had seen was that all of the assets in the questions of the gift relief claims that we'd been dealing with would indeed qualify for gift relief. But if you remember when we dealt with rollover, right at the very end of our study of rollover relief, we said and posed the question, what about if only part of the asset had been used for trading purposes? The typical example where an unincorporated trader owns a property, most of which is used within the trade, but maybe a proportion of which, a percentage of which is let out, making it therefore investment. Well, what we know, of course, is that the reliefs will only pertain to the business use element. And so it is when now we look at gift relief, where only part of an asset is used for trading purposes, or where an asset has been used for only part of the donor's period of ownership, then gift relief would be restricted. We're going to have to apportion that. Now, much the most likely scenario for you to see a restriction of gift relief down to the situation where a part of the asset is held in the form of an investment, by far the most likely scenario is this one in note B here. That is where we're dealing with it's a gift of shares. Now we know that gifts of shares in either unquoted trading companies or personal trading companies, so quoted companies where you own 5%, qualified for gift relief. So where the giftee shares and the individual owns at least 5% of the voting rights, so whether unquoted or quoted doesn't matter now, where the individual owns at least 5% of the voting rights, then in that situation the capital gain on the shares eligible for gift relief will be restricted, and it's restricted to this following fraction. We will learn it as CBA over CA, where CBA stands for chargeable business assets and CA for chargeable assets. And the figures that we will include will be provided, of course, to us within the question, will be the market value of the company's chargeable business assets over, again, the given market value of the company's chargeable assets there. Now, what are these chargeable business and chargeable assets? Well, the chargeable business assets we'll define in a moment, but chargeable assets will basically be all of your CBA, so everything that is on the top line, plus the market value of the investments, the non-trading assets, the investment assets held by the company. So, chargeable assets, just move to note 3.7 here. An asset cannot be a chargeable asset where any gain that might arise on the disposal would not be a chargeable gain. Now that's just the technical way of saying that, of course, it will rule out exempt assets. So if there are exempt assets held on the balance sheet of the company, which there may be, such as motor cars, then those are not chargeable assets. Other examples of assets that would be exempt, usually when you look at plant and machinery, and where you have plant and machinery, watch out for the chattels exemption. So if the plant and machinery is movable here, it's tangible movable property, that was a chattel, and it would be exempt if both bought and now valued at less than £6,000. Any individual items of movable plant and machinery where we have bought for less than £6,000 and they are valued at less than £6,000, that is covered by the chattel exemption. So again, such plant and machinery would not be a chargeable asset because like cars would be covered by an exemption from CGT. But your other plant and machinery, now that would represent a chargeable asset. So it says here that we've excluded those exempt assets, but that does not include, but not those that could produce a gain on disposal, but currently stand at a loss. Now this is that point again about the rest of your plant and machinery. Plant and machinery, other than that which is covered by the chattel exemption, will represent a chargeable asset, chargeable assets, because on their disposal, if disposed of for more than cost, then it would give rise to a gain. But of course, although if disposed of for more than cost it would give rise to a gain, thus it is chargeable, the vast majority, if not the entirety of plant and machinery, will of course be valued now at a figure well below that original cost. It tends not to go up, but to go very quickly down in value, does our second-hand plant and machinery. But we will know that although it may stand at a loss, we would still be including this as a chargeable asset. So we have said this provision rules out exempt assets such as cars, but it does not rule out those assets that could produce a gain, but like plant and machinery is currently standing at a loss. So we will include any other plant and machinery. The fact that it is now valued at less than cost makes no difference. So this will include all chargeable assets held by the company. Now, plant and machinery, of course, used in the trade is a chargeable business asset. But in chargeable assets, we include all such chargeable assets, both those that are used in the business, properties used in the trade, plant and machinery used within the trade, even indeed the goodwill of the business, as we'll see in a moment. All of those would be included. But we also include as chargeable assets those held as investments. So you might have an investment property, for example, or shares in other companies that are held as investments. Those are all chargeable assets, but they're not business assets. The chargeable business assets are those used for the purpose of the company's trade, including, as we say, the goodwill, where that's been purchased before the 1st of April 02. You don't need to know the reason behind that, but again, it is that old goodwill. But excluding shares or securities here and any other assets held as investment. The most likely other one is a rented, a let property there. You own a property, but you don't use it in trade, you let it out. So we are going to limit, therefore, the available gift relief to that part of the gain on the disposal of the shares that is equal to the CBA over the CA, market value of chargeable business assets over chargeable assets. Now here we do work the gift relief as we did with rollover relief on a proportionate basis. This is not like entrepreneurs relief that we made mention of at the beginning of this chapter, where so long as it's defined as a trading company, you get entrepreneurs relief on the entirety of the gain. There's no apportionment. Either the gain does or does not qualify for ER, for entrepreneurs relief. But with rollover and with gift relief, we work on a proportionate basis. The proportions here in relation to shares gifted, chargeable business assets over chargeable assets. So let's then look at example 9 to now illustrate what is going on here. Oops, a bit too far. There we go. Calculate John's capital gains tax, so not just the gain but the CGT, on the disposal of shares in John Limited and the base cost of the shares there for his son. Right, John owns 100% of the shares in John Limited, and of which he is the managing director, so he's an employee. On the 1st December 15, made a gift of the shares to his son when the market value of those shares was £800,000. The shares had cost £200,000 back in February 2001. At the time of the gift, John Limited owned the following assets. Right, to begin with, do the easy part. Calculate what will be the gain arising on the disposal of the shares prior to dealing with any issue of gift relief. That is simple enough. We need the market value, 800, and we need the cost, 200. So write that down now in your answer. Do your calculation of the gain. Show the market value of the shares, £800,000, and show there the share cost, £200,000. So you'll have a gain, therefore, very obviously of £600,000. The question then is how much of that gain is eligible for gift relief. Now, to begin with, gift relief is available because we're talking about shares in an unquoted trading company. So yes, gift relief is available. But then we detect that there's a problem here, that gift relief will not be available on the full amount of the gain. And the reason being, there, on the balance sheet here given, well, it's an extract from the balance sheet, we're only dealing with the list of assets, we haven't got the liabilities here. Again, that's not the full value of the company, that's the gross asset value here, hence why the value of the shares is £800,000. We've got to take account of the liabilities, of course, in case you're wondering how come the value of the assets is 1.2 and yet the 100% share interest is only worth 800,000. This is just a list of asset values, not net asset but gross asset values. And on that list of assets there we have got investments. That, of course, is not a trading asset. So the gain eligible for the gift relief is restricted to our fraction CBA over CA. So we've got to go through these assets now and identify which of them are chargeable business assets and which above that are just chargeable assets. So let's look at what we've got. And again, on the face of the question page, at least if it's a written exam, you can write down on that question page CBA or CA. Remember, anything that's a chargeable business asset is obviously also a chargeable asset. Anything that is just CA is an investment. It's not a business, it's just a chargeable asset. Freehold trading premises, very obviously chargeable business assets. Goodwill, chargeable business asset. Investment, chargeable asset. Stocks and work in progress, debtors and cash, these are current assets. Their disposal does not give rise to capital gains. They are exempt. They are not chargeable assets. What you could have seen was plant and machinery, and if you had plant and machinery, you'd have to have a note to determine, of course, whether it was a chargeable business asset or whether it was exempt. If you were told plant and machinery consisting entirely of assets bought for less than 6,000, now valued at less than 6,000, then they would be exempt, so they would not be chargeable assets. If, of course, you were told that the plant and machinery contained no items there that had been bought for less than 6,000 or had values of less than 6,000, and also it was plant and machinery, it was not motor vehicles, motor cars there, then that would be chargeable. But motor cars, exempt chattels, would be excluded in deriving what your CBA and CA figures were. But here we've got chargeable business assets at £700,000 and chargeable assets, including the investments, at 800,000. Meaning, therefore, that the amount of the gain eligible for gift relief will be restricted to the fraction CBA 700 over CA 800. So only 7/8 of that gain will be eligible for gift relief. The remaining part of the gain will be chargeable, assuming then, we're told nothing to the contrary, that this is the only gain made by the taxpayer during the tax year. That gain will be eligible for the deduction of the AEA, and then the taxable gain will be taxed at. Will John here be eligible on that gain for entrepreneurs relief? Yes, he will. Again, he owns at least 5%, he's an employee of the company, and has been so for way more than just the required 12 months, so entrepreneurs' relief would be available. To deal with the son's base cost, the base cost would have been the market value of 800, but that now is reduced by the deferred gain, i.e. the gift relief. That was the gain multiplied by CBA over CA. So I'd like you therefore now to do that exercise for me, please, and then check out the answer with the answer in the back. Then come back and join us, and we'll then move on to the last of the reliefs that we need to be aware of, principal private residence relief. We now move on to the last of the reliefs that we need to be aware of so far as the individual is concerned. And this one is a different relief again to the ones that we've seen before. To remind you, entrepreneurs' relief was actually a tax rate, but a low tax rate for CGT, just 10%. The next two reliefs, rollover and gift relief, were deferrals. They allowed, in the situation of a disposal of a qualifying business asset, for gains to be deferred. That meant that there would be no immediate chargeability, but the gain would be deferred until a future point in time. But now we come to, I suppose, the best of all possible reliefs, and that is an out-and-out exemption. Now, the principal private residence, basically the house that you live in, your main private residence, is not an exempt asset, because, as we will discover in this section, it is possible that for part of the period of ownership of the property that you had your principal private residence, that you will not enjoy PPR relief. That's why we didn't list out the principal private residence amongst the exempt assets, because of itself it is not. However, if you live in that property, you occupy that property, as most taxpayers will do, for the entirety of the period of ownership, then all of the gain arising is covered by PPR relief. So for the vast majority of taxpayers, when they dispose of probably the only asset that they're likely to have any significant gain ever arising on, for normal taxpayers anyway, their principal private residence, they can look forward to principal private residence relief, basically exempting all of that gain arising. Now, if that were to simply happen in an exam question, it'd be a very boring question. So something more interesting has to have occurred. And that something more interesting is that there will be periods of absence from the property. The taxpayer, for various reasons provided within the question, will have left the property before eventually returning to it, and of course eventually, and what has happened in our tax year, selling that particular property. Now, you might think, based on what I've said so far, that for periods that you do not live in the property, that maybe that gives rise to chargeability. Well, in fact, it doesn't necessarily, because what we will see in section 4.2 of the notes in front of you is that there are significant periods of absence which will actually be allowed, will be deemed to be full occupation, and therefore no chargeability will arise. Most of your problems arise here, not in terms of the technical knowledge that you need to have, but actually in counting. It's actually counting from one date to another, how many years, and, well, to be honest, we're going to do our apportionments here in months. How many months is it for that particular period, either of ownership or of period spent away from the property? That you're getting your fingers out and counting through how many years, how many months will that be. That's your biggest problem here, rather more than the technical aspect. Technically, it's very straightforward. There's not that much to learn. So what do we need to know? In section 4.1 here, the sale of an individual's only or main private residence is covered by the principal private residence relief. That relief also covers, it's not just the property itself, but the garden, grounds of up to half a hectare there. The relief is available in full if the taxpayer occupied the property, as we've said, throughout the entire period of ownership. Where occupation has been for only part of the period, then a proportion of the gain is covered by the relief. And basically a very obvious one, calculate the gain. That's simple enough. It's a normal standard gains calculation. What did you sell the property for? What selling expenses did you incur? Take those away, get your net proceeds, establish your original and all other incidental costs of acquisition, plus any further enhancement expenditure. Deduct any and all allowable costs and you get the gain. What we'll then discover, based on the history of what the taxpayer has done while he or she has owned that property, is that we're then going to have to work out what was the total period of ownership. Well, that's, apart from the counting bit, simple enough, from when you bought to when you sold, and you will do these calculations in months, just to the nearest month here. And of that total period of ownership, what would be classed as occupation? Now, of course, that will include actual occupation, and no doubt for the majority of the time of ownership, our taxpayer will have lived in the property. But then there are periods of deemed occupation. So what are they? What is it that you now have to learn as being the periods of deemed occupation? Firstly, the last 18 months of ownership. As long as the property was the individual's main residence at some point in time prior to this, then the last 18 months of ownership will never be chargeable. It does not matter then within that last 18 months what you have been doing or where you have been doing it. The last 18 months will indeed be covered by this deemed occupation rule. We then think, well, why else would you go away from the property, leave that property for any extended period of time? Well, normally, of course, that would be for reasons of employment, for work. But you keep ownership of the property. You don't necessarily sell, and then when you come back to your normal place where you live, then go and buy another property. So you probably keep that property while you work somewhere else. Now, where might that somewhere else be? It might be that you go to work and live abroad. And there, very good news, any periods during which the individual required by his employment to live abroad, that will be classed as deemed occupation. You could be, of course, required to work elsewhere in the UK. Now there is a finite limit. Any period of up to 4 years, whoops-a-daisy, during which the individual is required to live elsewhere in the UK due to employment. So there we're limiting it to just 4 years for working elsewhere in the UK. And then, last of all, up to 3 years for absolutely any reason whatsoever. So, for example, you decided to take a break from your career and you went travelling the world for a year. Nice thought, isn't it? You went travelling the world for a year there. Now, as long as we'll see in a moment's time that you have returned to the property following that period of absence, then you could do that up to 3 times, up to 3 years for any reason there in relation to the period of ownership of this property. Right. Now, we've got various points. There's just a couple of little provisions we need to look at. In terms of points B to D, so other than the last 18 months, so working overseas, working elsewhere in the UK, 3 years for any reason there. Point D must be preceded and followed by periods of actual occupation. So the basic rule is to get any of those periods, we must, and this will be a must, we must have lived in it at some point, not necessarily immediately, but at some point prior to making any of those exits from the property, prior to any of those periods of absence. So it must have firstly become your PPR. It then says also, and followed by periods of actual occupation. But then, for points B to C, these were employment overseas, employment elsewhere in the UK. We have a bit of a let-out, that for points B to C, if the individual could not reoccupy due to the terms of employment, so you were still in that employment, then, which obviously required you to work elsewhere, be it overseas or be it elsewhere in the UK, then by concession, the condition of actual occupation following the period of absence is not applied. So if, for example, I were to take on a contract of employment in, say, Australia, and I go to work, live and work in Australia, I go on a 4-year contract. I then renew that contract for another 4 years. And at the end of that, I'm going to renew again. And I decide, you know what, I'm probably not going back to that property in the UK. So what I'll do, therefore, I will, while I'm in this employment, I will actually sell that property back in the UK. What this rule means is I am not required to leave Australia, go back to the UK, live in the property prior to then selling the property in order to get that period spent working in Australia, employment overseas, in order to get that allowable as a period of deemed occupation. So long as I am in employment at that point, in that employment, that is what prevents me from returning to the UK, then I don't have to return to the UK. I don't have to go back and live in the property prior to sale. Now be careful. Again, they can get a little bit tricky here, the odd question. If I went to live and work in Australia, as I said, for 4 years, 8 years, 12 years, whatever, then as long as I was still in that employment and I decided then to sell the property back in the UK, I wouldn't have to go back and live in it. But if, for example, I had retired from that employment, so I was no longer working, I had retired, then I must return to the UK and live in the property prior to sale to get my period of deemed occupation, because I would no longer be prevented from returning to the property by reason of that employment. I'm no longer in it. I have retired. So just watch out for that one. Very, very occasionally they put that into a problem. But for us, again, normally you go overseas, you think, actually I'm going to stay here for a lot longer. I'm going to sell that property back in the UK. They don't drag you back to the UK to live in it prior to sales. You'll still get your period of deemed occupation. And so it is also if you're still in that job elsewhere in the UK there. They don't drag you back to the property to live in it. As long as you're prevented from returning because of the employment, you will get your period of deemed occupation. But that concession does not extend there, I should say, to point D. If you want the 3 years for any reason to apply, then you must return to the property prior to sale. Now, there is no set period of time for which you must return. There's nothing which says how long that is, but it will be clear within any exam question whether prior to sale you have or have not returned to the property. Okay, we've got now our example 10 to illustrate. Calculate the gain arising. Right, David bought a house on 1st of April 86 for a princely sum of £10,000. He lived in it until the 30th of June 86. So now what we start to get is the history of occupation or otherwise of that property. That is then the analysis that we'll have to do, and we'll show you how to perform that analysis in a moment's time. He worked abroad, so overseas, for 2 years, and then moved back into the house on his return on the 1st of July 88. So he's actually lived in it. We then got deemed occupation, working overseas, of course, is deemed occupation. And then lived in the house until the 31st of December 2002. Actual occupation again. So far, so good. Before leaving to live and work elsewhere in the UK. Now, David did not return to the house, and the house was then sold on the 31st of December 15 for £150,000. Now, I will go through this with you, but what I want you to do, and therefore to pause once I've told you what I want you to do here, what I want you to do is, one, the simple calculation of the gain here. What will be the gain? Well, as I say, it's simple enough. We sold for £150,000, the cost was £10,000. So I think we can quickly see, therefore, that the gain will be £140,000. Then, because it'll take a bit of adding up, you'll need lots of fingers here and a calculator to hand. You now need to work out what are the periods of occupation, both actual and deemed, and what therefore are the periods of non-occupation, in order that then we'll be able to apply to that gain figure of 140,000 that calculation there, taking the period of occupation, both actual and deemed, over the period of ownership, and that will represent the PPR relief. So I'd like you to spend a few minutes working out what you think those time apportionments are going to be, and then return to this example, and we will review through the answer that we should have got. Okay, let's see what we should get therefore and how to lay out our answer to example 10. If you haven't yet done it, again pause it rapidly, don't look at the answer in front of you, and you try and work out the various periods there, as we said, of occupation, be it actual and deemed, and therefore what would not classify as occupation and give rise to chargeability. Okay, assuming now you've done your calculations, let's see what we've got. The easy bit to begin with, the calculation of the gain. We know the proceeds, we know the cost, we know the gain. Now that calculation could have been made more interesting. We could have been told, of course, that when we sold we incurred selling expenses, agents' fees, legal expenses. When we bought it we incurred other incidental costs of acquisition, legal costs again being incurred. Following when we bought it we might have added an extension, a conservatory, whatever, and therefore had enhancement expenditure. Again, just spicing up the calculation of the actual gain. We also detected that the property would have been the taxpayer's principal private residence. But then what level of PPR relief? Now the basic working that we need here. We're going to run two main columns. Those as to record the occupation, whether that is actual or whether it is deemed. If it is deemed occupation, then you'll need a note about why it is deemed occupation. What is the reason for that, as we'll see in a moment. Then anything, of course, that does not rank as occupation, be it actual or deemed, anything falling outside of that category will be non-occupation or absence. So how many months will be absent from the property? What we'll also need, of course, is a total. Now you don't need to run a column for that, but you would cross-cast there those numbers and then check out have you got the total period. As I said, your main difficulty here is in counting up the number of the months. The principle should be straightforward enough. Now in the question we were told that David bought the house on the 1st of April 86 and lived in it until the 30th of June. So we've got some first 3 months there of actual occupation. It was important to know that prior to leaving the property that there was actual occupation. If he'd bought it, not lived in it, and gone abroad as he did to work overseas for 2 years, then those 2 years would not have classified, therefore, as periods of deemed occupation. So it was essential that he had occupied for some time, for some period, the property prior to leaving. So actual occupation, 3 months. In it goes. We then worked overseas for 2 years, so that's 24 months of deemed occupation. The reason, working overseas. And that could have been as there 2 years, it could have been 20 years, there is no time limit placed upon that. Then came back and lived in it. Now this, as I say, is where you've got to get your fingers out and start counting through from the 1st of July 88 through to the 31st of December 02. And that is probably the hardest part of the problem. So what I do is I start from the 1st of July 88, go forward in years. So was he still there 1st of July 89, 90, all the way through to 01, 02, yes, still there 1st of July 02. How many years is that? Multiply out by 12 and then add on the residual number of months. From the 1st of July to December would be another 6 months to add to that. Now hopefully when you have done that, that gives you, at least I hope I've got it right as well, is that the actual period of ownership, their actual occupation, was 174 months. So everything was fine up until there. There's no periods of absence. But then from the 1st of January 03 through to the point of sale, 31st of December 15, there was a period of absence. There was no further occupation. So what therefore can go in as deemed occupation? Well, without any other checks, the last 18 months. That is going to be deemed occupation. But what was the reason why the taxpayer David left the property for that period of time? He went to live and work elsewhere in the UK. Right, working elsewhere in the UK, 4 years is the limit placed on that. 4 years, that is 48 months. So 48 plus 18, well, that's where the 66 comes from. Now, of course, there was another issue to contend with, and if this was a written question, you'd have put a note in about this at the bottom of this exercise as well. And that further point is, do you get the 3 years for any reason? Can you add into that deemed occupation another 36 months there? Now, the answer here is no, you can't. Now, why don't you get the 3 years for any reason? I hope I hear you saying, because, of course, he failed to return to the property prior to disposal. If he had returned to and lived in the property prior to disposal, then the 3 years for any reason would have been available, and another 36 months worth of deemed occupation would be deemed to have occurred. But that did not happen. So you count through again from 1st of January 03 through to the 31st of December 15 and see in total how many years and therefore how many months that came to, of which we know 66 months was the period of occupation, both here, well, not actual but deemed occupation for the reasons that we've stated, 4 years for work elsewhere in the UK, and without question the last 18 months of ownership. Take that away from the total of whatever we've got, and that is some 90 months there, again assuming that my calculations are correct. So 267 months of occupation, 90 months of non-occupation, in total therefore some 357 months of ownership. Again, check that that is correct from the 1st of April 86 to December 15, just to make sure that you have got the correct numbers here. Again though, so long as you demonstrated, as long as this is not an objective testing question, if it's a written question, as long as you've demonstrated the process in the way that we put our working together here, the worst that can happen is you lose a mark because you've not correctly computed the number of months. But let's hope that that is not the case. So what PPR relief do we get to go against that £140,000 gain? PPR relief, you take the period of occupation, 267 months, over the total period of ownership, 357, and multiply by the gain of 140,000. That will give us the PPR relief, and that is here £104,706, giving rise, it would appear, to that balance as the remaining chargeable gain. Now, have a little look through, have a little think about that, make sure that you are happy with it, so pause at this point before we then move on to deal with the final remaining issues here on the PPR relief. Okay, the last couple of issues now to contend with for us to now finish off this section, indeed this chapter on CGT reliefs. In the previous example, dealing with David there, we saw that there were extended periods away from that property. Again, they were principally due to employment. First of all, had a couple of years working overseas. That was again deemed occupation, and then a very extended period of time leading up to the date of disposal where there was again working elsewhere in the UK. Now you think about it. If you're going to leave your property but still own it for such an extended period of time, are you likely to leave this valuable asset just sitting empty there? The chances are that you won't. That probably what would you do with the property? You would let it out. Now that is going to have several taxation consequences so far as you are concerned. First of all, if you were to let the property out, that would generate UK taxable income. You would have to work out your property income assessment, as we did in the earlier chapters on income tax, looking at the rental income accrued, less the allowable expenses incurred, and that information must be declared, of course, upon your tax return that you submit for each tax year. So there's the possibility that there would be an income tax assessment arising on that income. But hey, you're making money, you're making a profit there in relation to that property, you pay tax on it, so be it. Now, although there'll be a tax charge, you're still making a profit, so that's good news. But there's also good news when it comes to the capital gains tax position. Because, as in that last example, we firstly apply the PPR relief. Now, that gives rise to some chargeability. Why? Because we have a period of months of non-occupation, a period of absence that doesn't qualify as deemed occupation. Then there's some chargeability. Now, if we have been letting out the property during our periods of absence, then that gives rise to a further relief known as letting or lettings relief here. And that letting relief is available to cover any gain that has not already been covered by your PPR. Now, it arises in either of two circumstances. Much the most likely of these is the first one, that's what we're talking about now, that the owner is absent from the property and it's not covered by the periods of deemed occupation rules and therefore has given rise to chargeability. And during that period, the property is rented out. If that is the case, then lettings relief is computed as, now again, this not necessarily immediately, but by the time you walk into that exam room, is another learning exercise that you must undertake. Lettings relief is the lower of the PPR relief given, or a maximum figure of £40,000, or the one that usually is the answer, if not 40,000, the gain that is attributable to the period of letting. So if we were to go back to that David example, and we were told that throughout that period from when he went to work elsewhere in the UK through to the time of disposal, or at least any point into the last 18 months prior to disposal, that the property was let out. That would mean that lettings relief would now be available, and it would be the lower of the PPR relief given. Well, that of course was a very high figure. That was something over 100,000 as I recall there. You may still have it open in front of you. So it's not that figure. 40,000 is clearly a number below that. And then the gain attributable to the period of letting. Look at the gain, that was, I'm trying to remember now, 30-something thousand, I think. That is less than £40,000. Were we letting out the property throughout that period of ownership? Yes, we were. So all of that remaining gain of 30-something thousand pounds, being less than 40,000, would indeed be eligible for lettings relief. And that therefore would bring down that gain to zero. So this lettings relief could be a very valuable relief in taking up to a maximum of £40,000 of gain that remains post PPR relief and also exempting it. And that's what example 11 now brings into play. Now again, I'm going to leave you to have a go at this and to set it out in the way that we did example 10 and then to further move on to deal with the PPR relief. Let's have a look at what we have. Ken bought a house, again 1st of April 86, cost £30,000. Ken sold the house on the 31st of March 16 for £250,000. So it will be an easy enough calculation of the gain therefore. And then of that gain we have to firstly work out what PPR relief will be available out of the total period of ownership. So lived in it, that of course is actual occupation. Travels the world and lets the house, so not going for reasons of employment. Comes back, lives in it, and on that basis therefore the 3 years, the 36 months for any reason will be available for you in terms of deemed occupation. Finally then moved out of the house to live with his girlfriend, disgraceful, and the property was empty, so did not therefore let it out. The property was empty there. Now that should allow you to determine here, first of all, what is the total gain? 250 minus 30 will be 220. What amount of that gain is eligible for PPR relief? And then of the gain that remains, because not all of the gain is going to be, nowhere near all of the gain is going to be eligible for PPR relief, there will be some element of lettings relief then to apply. I'd like you now to have a go at that exercise, please. So just pause at this particular point in time, then we'll come back and review our answer to that. Okay, let's see what hopefully we have got, or at least something like here, this particular exercise in terms of the answer. Again, do the easy bits first, calculate the gain. There shouldn't be a problem, the gain is £220,000. We then need to firstly establish the level of PPR relief, so we need to know what is actual and deemed occupation and what is non-occupation. In terms of the total period of ownership, this one a fairly easier one to work out those number of months. Acquired on the 1st of April 86, sold 31st of March 16, so 31st of March, 1st of April, exactly a year. 86 to 2016, therefore, how many years will that represent? That therefore will be some 30 years in total, and 30 years at 12 months will be 360 months of ownership. So the total period of ownership, 30 years at 12 months per year, that's the usual standard anyway, and we're talking 360 months of ownership. Now the harder part, the analysis. Right, from the 1st of April 86, we were told, through to the 31st of March 88, lived in it. So that's actual occupation there for 24 months. From the 1st of April 88 to the 30th of September of 93, we just went away travelling the world and we let the property out. What do we say in terms of PPR relief? That meant that we would here be able to claim the 3 years for any reason. Why? Because we did take up some actual occupation again after that period of absence and prior to the eventual disposal. So that's another 36 months here, this time of deemed occupation, the reason 3 years for any reason. Out of the total, what therefore is left as being absence from the property, well, I made that another 30 months there, and I've just put a note to myself that during that 30 months the house was let. That therefore will give rise to the availability, as we said, of our letting or lettings relief there, but more of that anon. But it does mean now we've got something going into the non-occupation, the absent column, so there will be some chargeability in relation to the gain. It will not all be eligible for PPR relief. We then got the period from the 1st of October 93 through to 31st of March 03, where we lived in it. Again, hopefully working through the number of months, that's actual occupation, in it goes. Finally, the period from the 1st of April 03 through to 31st of March 16, moved out of the house to live with his girlfriend, the property was empty. Not therefore moving by reason of employment. We've already had the 3 years for any reason. You only get that once during your period of ownership. You can't keep going away for 3 years, coming back, going away for another 3 years. It doesn't work like that. It is 3 years in total here. So the last 18 months will be deemed occupation, and the rest of it will class as non-occupation. However, we left the property empty. There was no letting of the property there, so that will not rank for any available lettings relief. So add down our columns out of the total period of ownership. Hopefully that gives us, again if I've done it right anyway, 192 months in terms of occupation, both actual and deemed, out of the 360 months of ownership. That therefore gives rise to the available PPR relief, which again, hopefully the calculations of which I've done correctly. The occupation, period of occupation 192 months over the total period of ownership 360 times the gain, up there again, £220,000, gives us our PPR relief. Take it away and we've now got the remaining chargeable gain. But that then is still the subject of a further relief, letting relief here. Now that letting relief is limited to the maximum of, firstly, the PPR relief. Now the PPR relief here was 117,333, as we got up there on your PPR relief. Now we know it's not going to be that one because 40,000 is the maximum. We of course take the lower of these three figures, so 40,000 is a maximum. But then the proportion of the gain attributable to the period of letting. Now, had we also let out the property during that final period of absence for that 138 months, or at least all of it bar any part of the last 18 months, then we would have had the lettings relief going higher. It would be higher than 40,000 indeed there, and on that basis 40,000 would have been the lettings relief. But we didn't. We only had 30 months when the house was actually let out during a period of absence that was classified as non-occupation. So 30 out of the total of 360 months of ownership times what was the total gain, 220, brings us down to the lowest of these three figures, the proportion of the gain attributable to the period of letting. Take away your lettings relief and you are left with your bottom line figure of chargeable gain. Now, take another moment to review through that. Just pause for a moment, please, and then very briefly we'll finish off the very final part of this, I promise. Okay, very final part now is just this note 4.3 that we still need to consider. By far the most likely reason why some part of the gain made on the disposal of your PPR is not covered by the PPR relief is because you had a period of non-occupation, a period of absence from the property. But there's another factor that could of course give rise to chargeability. It's known as Principal Private Residence Relief, PPR, Principal Private Residence Relief. But what may have happened, and you'd be told this of course in the question, is if you had a part of the residence that is used exclusively for business purposes, if that was throughout the period of ownership, the gain in relation to that part is not covered by the relief. So if therefore you had a gain on the disposal of your PPR of £100,000 and throughout the period of ownership you had 10% of that property given over exclusively for business use, you've got an office effectively within that property, it is only used for business purposes, that is it, then on that basis 10% of that £100,000 gain would not be covered by the PPR relief and would be chargeable. Now of course would that be a problem? Well, not necessarily. If you only had a 10,000 gain in the tax year it was the only gain, that's covered by your AEA anyway, so you still wouldn't have a problem. But we are going to restrict here that PPR relief, and there would be chargeability to the extent that a part of the residence has been used exclusively for business purposes. Now of course it may be that you owned the property for 16 years, and for only 8 of those years, 8 out of the 16, have you had this exclusive business use of that part of the property. Then only 8/16 of the gain would be subject to the chargeability for the 10% part of the property that was used for business purposes. You'd have to time a portion there as well. Just one thing when you time a portion, the last 18 months rule in terms of your PPR relief does not apply to that part, that's the part used for business purposes, unless the business part was at some time used as part of the only or main residence. If from the day you acquired to the day you sold, throughout the period of ownership, that particular part of the property has always had the business use, then you can't exempt the further 18 months of that period in relation to your PPR relief. The last 18 months rule does not apply to that part, the business element, unless the business part was at some point used as part of the only or main residence. Again, it's a tiny little point. By far the most important aspects of this, learning the periods of deemed occupation and the added on bit about lettings relief there. Okay, well that brings to a close our study of the CGT reliefs for individuals, and indeed the study of CGT for individuals. We've not finished by any question here the issue of capital gains, because when we then go on to look at corporate tax, we will then be looking at the specific capital gains issues pertinent to companies within corporate tax. Now, this, of course, this chapter is followed by chapter 15. That's a surprise, eh? Chapter 14 is followed by chapter 15. I bet that's a surprise to you all. But chapter 15 deals with the administration, self-assessment and payment of tax for individuals. Now that's a chapter that I'd suggest that you skip over at the moment. A lot of that is just learning the admin, and depending on how close you are to the exam, there's no point trying to learn that stuff now, because by the time we've crammed our heads full of, well, I'd say more important stuff on the remaining taxes and how those taxes work, we're likely to have forgotten it. So better therefore to do all the other working type stuff on the other taxes. That will begin with chapter 16 and corporation tax there. Better to do that, and at the very end therefore of our studies, once we've done all the doing things in relation to taxes, we've got corporate tax to do, we've then got individual substantial chapters, but individual chapters on VAT, value added tax, and IHT, inheritance tax. Do all of that first of all, and then we'll deal with the administration so far as our tax system is concerned, both for individuals and also then for corporate tax for companies as well.